Let's go to Mary.
This is an RNZ podcast.
Hello and welcome to this episode of Your Money with me, Mary Holm. Thanks for taking just a few minutes to listen in while Jessie Mulligan and I talk through some useful ideas about how to make your money work better for you. Just remember though, this is guidance. Final decisions are up to you. Over to Jessie.
Mary Holm now. Time to talk money with financial journalist and author Mary Holm, who's looking today about what we should be doing, particularly in regards to low mortgage rates. Hi, Mary.
Hi, Jessie.
Nice to talk to you.
You too.
They've fallen.
You sound a bit coldy. Are you all right?
Oh, you know what it is. I had a cold and I got tested for COVID-19 and got found to be negative. And then I just got this sinus thing going on that just goes on for weeks and weeks and weeks. Not contagious, just quite annoying.
Take care.
Thanks. Pleased to have you do the heavy lifting for the next 15 minutes though, Mary. Tell us about mortgage rates. What are they doing?
Yes. Yeah, in the middle of all, everything else going on, I'm not sure that people fully appreciate how much mortgage interest rates have dropped. I was just looking at some numbers the other day on interest.co.nz. They have the bank averages, the average mortgages. Since August, floating rates, the average has gone down from 5.7 to 4.4, which is a huge drop. Yeah. With fixed rates, not such a big drop. It's gone down from around 4.5, 4.7-ish, down to about 4.0. The average, it varies with the term of the mortgage. But so as a result, floating and fixed are closer together. But anyway, the point about all this, you and I have talked lately about a couple of other things about mortgages, other aspects. One was mortgage deferrals, which I'm adamantly not calling mortgage holidays.
Yeah.
And how they're not a holiday. So people absolutely who need to take them, if your income's gone down and you need to take them, there's nothing wrong in that, but don't do it unless you have to, because it does just mean you end up paying more total interest on your mortgage over the long term, and the whole loan will spread out longer for more years. So that's basically the idea around that. And then last time you and I talked, we were talking about whether people with mortgages up for renewal, whether they should go for fixed term or floating, or whether they should go for short term or long term. And I said what I always say, which is a mixture. But I do have to say that I was talking to a friend this morning, and he was saying what should he do. And at his bank, the one-term rate was a lot lower than one-year term was a lot lower than the longer terms and the floating. And I said to him, gosh, you might be tempted just to go with that 1 year low rate because it's only around for a year. Whatever happens, the worry with term mortgages is always that interest rates will drop even lower, and you're stuck with what suddenly looks like quite a high rate. But in the current environment with so much unknown, who knows what's going to happen to the economy and interest rates, etc., in the next year or so. So just sort of tying it up for 1 year didn't seem like a bad idea to me, I must say.
Yeah, I've often thought that as well. If you see something that you like, that suits your budget, you can budget accordingly and you're satisfied, why not take it?
Yeah, there's something to be said
instead of
that.
chasing your tail and trying to continue to, get the latest and greatest every 6 months.
Yes, look, that's true. I mean, one big advantage of fixed-term mortgages is that you do know exactly where you stand.
You can plan.
Yes, and at the moment, in this current environment with so much else up in the air, so what I'm saying is I don't blame people if they say, to hell with what Mary said, I'm going with a 1 year fixed rate. Yeah, I think there's something to be said for that. But what I wanted to talk about today was that with all the mortgage rates going down as much as they have, people who are feeling that they're reasonably secure in their income, it's a really good idea when rates go down to try and maintain the payments you were making before. So that even though that the amount you have to pay has gone down, you're voluntarily paying more. And I just worked through one little example on a 30-year mortgage of $300,000, and let's say the interest rate's gone down from 4.5 to 4, so you're paying $88 less a month, which, that's quite nice, but it's not a huge amount different. And I'm saying if instead you say to the bank, no, look, I want to keep paying that extra $88, you'll end up, if it's a new mortgage and it's got 30 years to run, you'll end up saving nearly $26,000 in interest by maintaining that $88 a month, which is huge.
Incredible.
And what's more, you pay the loan off more than 3 years earlier, and that's also a big thing. If you're staring down a 30-year mortgage, you might think, who cares, whether it's 27 or 30 years, but as you get towards the end of it, and you might be in your 50s or 60s or whatever, by the time you get into the end of the term, having 3 more years of mortgage that are mortgage-free and that you can get in and save for retirement or have a bit more fun, or both, is quite a big deal. And if you had a $600,000 mortgage, you'd double those numbers. So with a $600,000 mortgage, you'd be saving about $52,000, getting up to $52,000 by maintaining the current pay, the old payments when the interest rates go down. It's huge, the difference it makes.
Yeah.
So I'm saying that's a really good thing for people to do. Having said that, there are probably quite a lot of people out there at the moment who are saying, look, I don't quite know how strong my job security is at the moment, or I might run my own business and I don't know what's going to happen there, or there's a lot of insecurity out there. And so, perhaps rather than necessarily saying to the bank, I'm going to keep paying that $88 extra a month, instead maybe set that $88 a month aside into a bank account. Maybe open a new account or just have a specific account with that in, and just be putting the money into there in the meantime. And then, obviously, if you need it in the next 6 months or year, or however long things are disrupted for, obviously the money's then there for you to easily grab it. Whereas if you're paying extra off the mortgage, you might still be able to get that money back. Something to ask a bank. If I pay extra off the mortgage, can I get that money back easily if I need it? And quite often they will say yes. But some people might feel just a bit more secure just saving it themselves. And then, once the COVID-19 crisis is over, because it will end, then if you've got that lump sum sitting there and you didn't need it, then you could perhaps pay it as a lump sum off your mortgage when your fixed term ends or whatever. So,
or you're always quite keen on having, about 3 months worth of salary. I think that's your figure, or maybe you think that's a little high. But anyway, having something there for a situation like this, so maybe that's the opportunity to save it.
That's a really good point, Jesse. Yeah, that a lot of people don't have as big a rainy day fund as is ideal, And the 3 months income, it's interesting. I've often thought and said, oh, that seems a bit much to me, but when you look at the current situation, suddenly it doesn't seem a bit much. And that's what rainy day money's about, a setup that in normal times you think is a little bit silly, a little bit kind of too cautious, and suddenly things like this happen. I mean, this is a very unusual one, but economies do lurch downwards, or particular industries get into trouble or whatever, or people have health problems. So, yeah, you're right. Just set it up as a rainy day fund and leave it there, call on.
There'll be some people thinking, well, that's all very well, but I'm not actually going to benefit at all from these lower rates because I'm on a fixed. I guess the message to them is, great opportunity to have another conversation with your bank once the fixed term comes up. Or sometimes, I think you've told me, Mary, you can actually chance a call to your bank and say, hey, what do you think? Can I refix?
Yes, yeah, that's right. You can, I'm talking mostly to people whose fixed term has just ended, or they're on a floating rate,
Yeah.
or it's about to end. It never hurts to go and talk to a bank and see if they're willing to negotiate a deal where you can change, get out of your commitment. The trouble is, when interest rates are going down, the banks are not going to be all that interested in talking to you. They're quite happy
Right.
with your rate sitting there at your mortgage sitting there at a higher rate. So if you went to them and said, I want to break this mortgage and move to something lower, they're going to charge you quite a big penalty for it. That thinking applies more if interest rates are going up and for whatever reason you want to shift to a new lender or something like that. Then if you go to your old lender and say, I want to break my commitment here, they're quite keen to listen to you if mortgage rates are going up, because then they can get your money and lend it out to someone else at a higher rate. So that, the attitude the bank presents depends a heck of a lot on which way interest rates are going. But the final point I wanted to make is just a warning that these rates are incredibly low. Some of them are below 4%. It's astonishing, really, by historical standards, and they won't stay low forever. And, the last thing I want to do now is give people another reason to be worrying about their money, but just don't count on... if, for example, you were thinking of investing in a rental property, which people probably aren't so much this month, but they might be in the months to come, especially because house prices look as though they're likely to go down. And so some people will be thinking, this is my chance to grab a rental property, and mortgage rates are really low at the moment, and so, house prices down, mortgage rates low, this is looking good. When you crunch through the numbers, don't count on those interest rates staying that low. I don't know any more than anyone else really what's going to happen to interest rates, but when you look over the long term, they go down and they go up, and, they can get up into the teens. I don't think that's going to happen again in a hurry, but I'm just saying don't count on them staying this low for years into the future, really.
Yeah, plan on them going up at some points.
Yeah, just think about, if you're thinking of trading up to a nicer house or buying a rental property or something like that, just think about how you would cope if rates do go back up to, from 4-ish to 5 or 6, those sort of numbers. It's worth just, there's heaps of mortgage calculators online, and you can just key in your numbers and then have a look at what would happen. The ones that annoy me, actually, the bank ones where, in fact, I was looking at the calculators this morning, some of the bank calculators would only let you put in the interest rate that they're currently charging on, their 6-month rate or their 5-year rate or whatever. They won't let you just put in whatever interest rate you want to put in. So any banks that are listening, please just give people the option of putting in their own interest rate, because then you can play around with it and see, okay, now what would happen if the interest rate went up to 6%? What would I then be paying? So, as I say, I don't want to worry people, because there's enough people worrying out there at the moment already, but just keep at the back of your mind that what you would do if mortgage interest rates rose, and therefore don't get too, foolhardy about buying a rental or something like that.
Mary, great to chat. Thanks so much.
It's a pleasure, Jesse.
Mary Holm, personal finance expert, with some advice on what to do. Actually, we don't call it advice, some thoughts on what to do with those mortgage rates falling quite substantially.